Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course, help to make it actionable, understandable, and clear. What a week, and therefore, what a show. Thanks to the friends of the show, we've got some content. I appreciate those that sent articles my way. Our first article is one such instance. Headlined, ETFs are flush with new money, why billions more are flowing their way. We're going to learn what sort of movement we are a part of. We weren't referenced in the article, but goodness, I guess they could have. We'll also look at just practical day in the life of a citizen in America in a potentially lowering rate environment. Should you refinance your house? What does that mean? What are the benefits? We'll look at how have index funds performed internationally. It's a drum I've been hammering for a while, so here we go. And then we'll close out in a technology article. 9 technologies that have transformed our investing, another Wall Street Journal article. But let's start at the top. ETFs. ETFs are flush with new money. Why billions more are flowing their way. A little definitional work. What is an ETF? It's an exchange-traded fund. So this is the new innovation, not really that new, but the traditional mutual fund. You've heard of the mutual fund. The ETF is very similar. It simply trades throughout the day like a stock and has some benefits. It's a lower cost product and sometimes more tax efficient. This article explains a new development that's occurring, but check this out. U.S. listed ETFs have taken in a net $917 billion with a B through September 29th. So if the pace holds, you're going to have $1 trillion for a second straight year. So the article explains a little history here. The 1990s, these things started. They're a cheap and efficient way to basically be an indexer. They've got active ones now that we don't have no interest in, and a whole host of other products. But there's a new regulatory development, and we're going to put our glasses on for this and our thinking caps. The SEC, the police officer of the investing world, the Securities and Exchange Commission, it's going to grant something called exemptive relief to dimensional fund advisors. So our beloved Vanguard, they patented the ability to have a dual share class structure. So it was a kind of a messy deal. You had these mutual funds and they came out with ETFs, and are you allowed to treat them the same? Well, Vanguard patented it, and it was extra beneficial in the tax efficiency of their mutual funds, because these ETFs actually have a couple tricks up their sleeve to make them more tax efficient. So all things being equal, when someone says, hey, I might either buy the ETF or I'll buy the mutual fund, I say buy the ETF. In the early days, there were concerns, are these products going to be for real? Will they ever de-link with the asset that they hold? Will it be, will it trade at too great a discount or too great a premium? No, for the most part, you're going to be better off with these ETFs. It's just a better product. So folks in the industry think that, yes, dimensional fund advisors popularized a style of investing that's similar to indexing. It's just a little wrinkle on it. They basically will take various factors and say, oh, we'll scrub it, and we'll only do companies that are growing earnings a certain way or that are more value tilted, and they're very successful. So this will be big, because this will mean just the ETF world is going to only get bigger and bigger, because this is where people want to go with their money. This is wild. This is the top net ETF inflows year to date. The Vanguard S&P 500. I'm guessing here it's between 75 and 100 billion. I'm going to say it's about $85 billion is how much has gone into that ETF to date. That's the S&P 500 Vanguard Fund, VOO. Expense ratio 0.03%. That's a lot of money year to date. Next closest was the iShares S&P 500. So I see more and more money flowing to the ETF, and something that for you to consider how far we've come. The Vanguard S&P 500 ETF is not sold. There's not a sales force out there promoting it. Advisors may recommend it. but there's not a commissionable event that folks are getting for distributing this. That was the way products used to be promoted. You'd have a distributed sales force of advisors who would earn commissions promoting certain products. This is a product you buy without a commission, without a load, they used to call it. They still do call it, but they're getting rarer and rarer, thank goodness. A fee to actually participate in the fund. People just bought this. They saw the merit of the product, how inexpensive and tax efficient it was, and they said, yep, I'll do that. Or an advisor like myself recommended it, and the client purchased it. But this is a much better way to allocate money. There are active ETFs. The article explains active ETFs now make up close to 10% of the market's assets. They took in 37% of the year's total inflows. So these active ETFs, sometimes they do have some folks pushing them. I'm not sure it's ever a commissionable event, but it's certainly a more profitable product for a company. There's margin in it, whereas there is zero margin in these index products. Keep that in mind. The companies that are charging you 0.03%, Vanguard and others, they're not making money on this. This is a break-even deal. Break even. So very rarely are you able to go into a marketplace and purchase a product where there is not a profit margin for the purveyor of the product, and it's best in class. Tough to find that. Aren't you glad you've got index funds? Aren't you glad that this momentum is foreseeable for the future? So keep joining. Just know there is an army of folks just like you who are taking the boring route, the low-cost route, the ruthlessly effective route, the route that no one cares about. No one will give you a medal for this, but it's the right route. And up next, in the personal finance world, we're beginning to see interest rates start to drop a little bit. Now, it's got a knock-on effect a couple different ways. For the borrower, this is splendid news. Whereas your 30-year mortgage may be at 8% or 7% or 6.5%, you may be able to get it in the 5s. 30-year fixed-rate mortgage. If you have your money on deposit at a bank or in a money market fund, you are not as excited about rates going lower. You're realizing that, that 5% money market rate is gone. I saw it. I mean, I'll check it live in studio right here. I'm going to guess 4.1%. It's at 4.08% today, this being Thursday. So it's starting to trend down. We'll see. But there may be things you need to do, listener. And we're big believers in keeping things simple and not making rash moves. But you may set your calendar for January and say, I need to revisit my borrowings, or you can do it now, and my depository relationships. Why is that? For one, a refinance may be very beneficial to you, particularly if you have a larger mortgage. So beneficial that the payback period, which is how soon can I recoup some of those refinancing costs? So the banks will charge you for this refinancing, and you got to get appraisal and all these things. You may recoup it in a matter of months. It may be very important for you to evaluate whether you should refinance or not. And maybe you called the existing bank, and maybe you need to, if the existing bank, for whatever reason, doesn't want to help, you find a broker or another bank. But I recommend you at least audit yourself and look at your rates and make sure that if you need to refinance, you do refinance, because it's big money over the long term. And then on the depository side, just be watching. Banks will be dropping their interest rates. And the best place, in my view, is still Vanguard's money market fund. Today, 4.08%, but it is almost always in the top 10%. You'll always find maybe a bank doing a teaser deal that's higher. But if you want to find a place where you can set it and forget it, I think that's the right way to go. For those of you who've just sat on cash and decided, I like the rates, I'm going to hang out here in cash, your hand may be forced. In fact, it was probably never a great idea to hang on to cash too long, but this is probably going to force your hand where you say, you know, if this thing gets below 4, what am I doing? I'm not really doing anything here. So this may be the push you needed to invest in the stock market or the bond market in a more long-term manner, not just hang out in money market funds. As fun as that is for some, and it is, it's a safe place. I know that. I know it can feel that way. And now let's talk about international exchange traded funds. If you're a frequent listener to the podcast over the many years you've been on this journey with me of keeping your costs low, investing simple, and time horizon long, you know that we started banging the international stock ETF drum a little early. We don't make predictions. There's that great quote, predictions are difficult, especially about the future. Maybe it was Yogi Bear, I don't know. But we talked about diversification and how there may be risks for folks who anchor so tightly to the U.S. stock market because it had had a 17-year run of outperformance against international funds. I'll say it again. 17 years, U.S. stocks outperformed international. However, the last 2 years, I just pulled this up, fresh data. I used VEU, which is one international exchange traded fund. You learned about those. One international ETF that Vanguard offers that I will recommend. It's up 40.7% over the last 2 years. Wow. What about year to date? How's it been January to present? It's up 26.07% year to date. Wowzers. Now, this was always the test because when we recommended, the royal we, that, hey, you should consider global diversification, it was still on the 17-year downtrend. And that's when it's hardest to consider diversification. And this may be a feint. This may be a false hope moment for international, but the U.S. dollar is depreciating, and therefore you're seeing the value of assets based in the yen and the euro increase. That's all gobbledygook for the most part. What really matters is, do you have a financial plan you can stick with where you're not going to chase performance? Do you have something that you can truly Rumpelstiltskin, set, forget, put your head in the sand like an ostrich and not think about? It's permanence, not optimization, that matters the most. In my years as a financial advisor, what has mattered most has not been, right asset, right time, agile and able to find the right place to put the money on the right year. I'm sure in theory that would work. I've never seen it work in practice. I see the inverse. Folks who think they have the capacity to understand market movements in that way are always chasing performance and lagging the returns they should get with a global portfolio because they're just playing whack-a-mole, trying to find where the outperformance is. There are whole industries devoted to this exercise that I think is a waterless spring, a mirage in the desert. Why it matters for you to have a portfolio with permanence is that the major variable we want to solve for is how long can you stick with it. So for some people, and this is always shocking when we have our first meeting and they tell me their story, which is what I ask for a personal testimony with money, how they relate to it, how they grew up with it, what their parents taught them, what mistakes they've made, what successes they've had. At the end of those stories, I hadn't happened a ton, but I said, you are not a candidate to own stocks. And I'll ask them if they agree, because of course they can own it. I'm an hourly advisor, I can do whatever they want. Oftentimes, they are relieved to hear that there's not some obligation on their part to own stocks. The volatility, fine by me. Own real estate. In a lot of instances, real estate is a better fit because it's not mark to market. You don't get the constant liquidity temptation. But you're going to be fine as long as you don't stick all your stuff in cash and just sit there. As long as you find something with some track record of returns and you can stick with it, you're going to be fine. And our final article, 9 Technologies That Transformed Investing from the Telegraph to AI. This is by Kenneth Pringle at the Wall Street Journal. Subheadline, in the early days of the country, each city conducted its own financial business. Here are the key innovations that changed everything. Now, this is interesting. I'm not sure a whole lot's actionable other than gratitude for the time you live in. It started with the Buttonwood Agreement. The New York Stock Exchange started. It was a single handwritten page. It was signed on May 17th, 1792 by 24 stockbrokers who often conducted business under a buttonwood tree outside 68 Wall Street. Boy, have we come a long way. Of course, I am ignorant as to the implications of some of these technologies because I was not around. I'll give more anecdotal evidence as I enter the picture. Born in 1985. It was still a transformative time to see change. The electric telegraph. Listeners, first in 1844, Samuel Morse catapulted New York into a leading position. So by the end of the 1850s, Wall Street was connected to every important American city, and it set prices for them all. So there you go. Wall Street matters. The railroad. Oh, yes. The railroad cut the time down sharply, allowing for a nationwide system of purchase and delivery. For those of you who have an Amazon account, you kind of scratch your head that it ever took more than 6 hours to get you the product of your choice. But now, we demand it, don't we? We want the product when we want it. Of course, railroad mattered. Stock ticker, boy, that was big information. Can you imagine not being able to see pricing? The telephone, married with a stock ticker, gave folks another helpful advantage. The electronic ticker came in. Those are these big things you saw with Gordon Gekko would use, these big box machines on desks at Merrill Lynch. Then electronic and online trading. This was a big one, very big one. It laid the groundwork for my favorite, online investing platforms. This was the innovation that really leveled the playing field, and it allowed for a practice like mine to exist. My practice would not exist without this, without the gatekeeper, which was the big banks who said, oh, you got to come to us. You got to use us. And they give two other technologies, high frequency trading and artificial intelligence. Of course, AI matters and they're changing it. But this online investing platform, we take it for granted. I take it for granted. Without this, and now I remember Scott Trade having $7 trades and thinking, wow, this is incredible. This article explains that when E-Trade came out about 30 years ago, it was $14.95 per trade up to 5,000 shares on the New York Stock Exchange and $19.95, about $20 for any number of shares on the NASDAQ. Scott Trade comes up with $7 a trade. Amazing. Now free is just normal. Without free, you're toast. What an incredible time to be able to invest. The individual investor has never been more empowered than they are today. And so of course, the real risk I see, you've heard me say it before, is just operate in ignorance, letting your emotions win the day and not following our favorite rules, which is to keep our costs low, investing simple, and our time horizon long, because that is what's going to give us the best shot on our investing journey. Until next week.